All right, today's the day, and we're looking at stocks down big. 30 minutes until the start of trading. I'm Matt Miller.
I'm Sonali Basak.
And I'm Katie Greifeld. Bloomberg Open Interest starts right now.
Coming up, the clock is ticking. Final deliberations over Trump's tariffs are coming down to the wire. All eyes on the Rose Garden today at 4 p.m.
Meanwhile, China is already taking action. Beijing reportedly restricting local companies from investing in the U.S. Details ahead on that Bloomberg scoop.
Plus, Tesla is about to reveal just how brutal the past 3 months have been. The car maker reports first quarter sales this hour. And with that in mind, let's get a quick check on the shares. You take a look at Tesla right now. Analysts are expecting 390,000 deliveries reported for last quarter. That's down from the nearly 460,000 that had been projected in early January. You can see the shares moving right now because actually we just got the news and it delivered 336,000 cars there. So less than expectations and well below those expectations heading into the year. Tesla shares down about 5% right now, Matt Miller.
Yeah, that's a big miss for Tesla. Nvidia is the second most traded stock pre-market. Those shares are down 17% this year, and it could be another 2% at the open. Investors awaiting details on tariffs, and they will impact, of course, chip makers like Nvidia.
And we're looking at the health sector, too. We're keeping an eye on chips. We're keeping an eye on pharma as well. In this case, Hims is down sharply this morning because it plans to sell weight loss drugs like Zepbound on its new telehealth platform. But investors aren't really responding. It's down more than 6% pre-market. And remember, this is a stock that is still up more than 28% really before this drop for the year. Now, President Trump's team is finalizing plans for those long-awaited tariffs. Investors are looking for any sign of clarity.
What I would want to do when I see the announcement, right, is just bring the heart rate down, take a look at what's on paper and what they're saying.
And once people have a chance to sit down and figure out whatever tariffs we're on, they're like, ooh, this is not good.
So if we have a 20% tariff across the board, prices are going to go up. So that's disconcerting.
The United States is a big, important country. That gives us leverage in the world. But we are not infinitely big and not infinitely important.
I think we have been in the process of destroying the American brand, and this hope that country after country would come and beg for a deal is changing rapidly.
The majority of countries in the world, their main trading partner is China, not the United States. If you made them choose, I'll bet they would choose China.
So anticipation building into 4 p.m. today, but Trump's tariff plans are still being worked on, according to White House sources. Let's get the latest from Bloomberg's Akayla Gardner joining us from D.C. So the White House has not reached a firm decision on their tariff plan. That was as of Tuesday, per people familiar with the matter. Akayla, talk us through some of the options that are on the table right now that are being hashed out.
Well, anyone looking for clarity is likely not going to get it until 4 p.m. today when the president makes this announcement in the Rose Garden. Anyone who knows this president knows nothing is final until he says it, till it's on paper, till it's on Truth Social. But right now we're hearing a few options are on the table. One would be a two-tiered approach where potentially countries could see a 10% tariff or a 20% tariff based on how the administration believes they treat them. One could be a more tailored approach based on countries' current tariffs on the United States and non-tariff barriers. Others are also reporting potentially just a flat 20% rate. But regardless, countries are already signaling that they're prepared to retaliate. We've heard from the EU, Canada, China. They're all preparing to really ramp up what has become a trade war. And President Trump is really willing to have that fight. We heard White House Press Secretary Caroline Leavitt say he's willing to get on the phone, he's willing to negotiate, but no signs that there's going to be plans to change any of these tariffs before they're announced and implemented tomorrow.
Well, what about after they're announced? With that much uncertainty still on the table leading up to that Rose Garden event, how much might things change even after they're announced?
Well, like I said, the White House is really open to negotiating. We've seen them do the same in the past with Canada and Mexico. But some have seen those negotiations and said, is it really worth it? Ultimately, those tariffs have are going into effect when it comes to Canada and Mexico. The president has said he's not happy with their efforts when it comes to fentanyl. So some people are wondering, we might as well just put these retaliatory tariffs on the U.S. to show that we're willing to have this fight. But again, the White House saying that President Trump is willing to negotiate and make those phone calls.
All right, Akela, thanks very much. Akela Gardner there talking to us about what we can expect from President Trump this afternoon. Now, Tesla first quarter deliveries missed estimates by a long shot. We were looking for 390,000 in the latest survey of analysts, and they actually gave us 336,681, beaten out by BYD of China, which delivered 416,000 fully electric vehicles in the first quarter. Bloomberg's David Welch is in Detroit to discuss. So, David, Tesla just continues to disappoint. Is this all because of Elon Musk's other activities, or have the sort of, first adopters already filled their garages?
It's kind of all of the above. So you can't have BYD gaining that much share, gaining that much in sales without it coming out of somebody's hide. And Tesla's a big player in EVs in China. So you got to think some of its competition, whether it's BYD in China and Europe for that matter, or General Motors, Hyundai, Kia, gaining share, albeit slowly, but gaining share in the U.S. That's going to take some buyers away from Tesla. It's his political leanings getting a lot of EV buyers in the U.S. are Democrats, according to some surveys I've seen. So those people are probably going to at least consider somebody else, if not run to another brand. And then, look, you do have the Model Y changeover. That's going to take down some production in plants. And generally, you bring up a good point. You have early adopters, luxury buyers who like EVs. They've got one or two in their garage already, so we're at the flat part of that S curve, as they say, looking for a catalyst for EV sales to pick up stronger growth again. And when you have more competition, less growth, and some other, let's call them, internal factors unique to Tesla, it's all really just driving down their sales at the moment.
And this, of course, follows their first annual sales drop in over a decade last year, David. So clearly these problems extend beyond Musk's political activities, if you phrase it that way. But talk to us about the potential bullish case for Tesla here. Obviously, there's so much bad news priced into the stock. You mentioned that Model Y switch over. To that point, Tesla did say that the ramp of the new Model Y continues to go well. There's some hopes and dreams built on robo-taxis. I mean, what is the best case scenario for Tesla to turn this around?
For investors to get excited about that, you have to believe that the smaller, affordable Tesla is coming soon and will sell well and make them pretty good money. You have to believe in the AI and robotics autonomy case, that the robotaxi is going to bring in a whole new kind of revenue that is lower cost for them. I mean, it would basically be subscription-based revenue for vehicles that are either out there or going to be sold. And it could be quite lucrative if it works. But we really haven't seen a Tesla model out there on public roads like we do with Waymo and some of the other companies like May Mobility, who are actually running out among other motorists, among pedestrians, fire trucks, and all that stuff that makes it very difficult to run self-driving vehicles. A lot of people have lost a lot of money betting against Elon's technology promises, but that one seems to be just a really difficult one to get out there and get generating revenue anytime soon. But you have to believe that if you're going to take the bull case on Tesla.
David Welch in Detroit, we thank you for your time. Good to see you so much this week. Of course, a lot to talk about autos and Tesla in particular. We're going to stick with it. We're going to bring in now New Street Research Global Team Head of Technology, Pierre Ferragu, who has a buy rating for Tesla, more than 465 here as a price target on the stock. Pierre, you're known as a Tesla bull, but these numbers, they've come in more than 50,000 below estimate. What do you make of them and the turnaround here for Tesla stock? You're certainly not seeing it this morning.
Yes, the number itself this morning is a particularly dire surprise, negative surprise. All the work analysts do to check channels, manufacturing, etc., were indicating like a bad quarter, but not that bad. Now, the underlying drivers of this bad quarter, what are they? The first one is that there is a new model Y being produced that stopped production for multiple weeks. It is the first time a car of that volume got upgraded across the world, like in all factories at the same time. So that's in itself a big disruption that is a one-off. Then the second aspect is we've known now for 18 months that Tesla has a significant issue. Something is standing between them and their growth potential. That's the price of their cars. Tesla is selling premium cars at an average selling price that is still in close to $40,000. And with that kind of expensive cars, it's difficult for them to grow more than they've grown already. So they need to bring to the market less expensive models, and that's still something that is planned for later this year, and that's going to help growth. And then last but not least, the economic environment, the uncertainty on the economic environment has historically had an extremely strong adverse impact on demand for premium cars. So people who like to buy a Mercedes, a BMW, or a Tesla, when they see stocks coming down and things like that, they think they're 401k, and they delay the purchase of their car. So that's the combination of these three factors that hit Tesla this quarter, and things should improve from there.
Pierre, I mean, it doesn't really matter, I'm guessing, for your forecast, if they sell 1 million cars a quarter. They could sell 2 million cars a quarter. It still doesn't work out to value this company at well over $1 trillion, which is where it would be if it were trading at 465. So why do you have a buy on this stock? It's certainly not about car sales.
Yeah, so I think the way the stock has been moving in the last few weeks is 100% related to car sales still. But the valuation, if you think about it as a multiple over like today's earnings power of the business, yes, you're totally right, Matt. It's all about the potential in robotaxis and the potential of Optimus, the humanoid robots. And there is like an order of magnitude higher earnings power in the deployment of these businesses than there is in purely selling cars. And so the reason why we have such a high price target is because what we've seen since the Robotaxi Day in October last year is that now investors are pricing into Tesla, in the multiple of Tesla, really like the potential of these businesses that are still going to take a few years to deploy. But this year we'll have very significant catalysts, very significant early indicators. The first test fleet of robotaxis by the end of the year, and the first mass production of Optimus, the humanoid robots. And these things, of course, are going to help investors look multiple years ahead when looking at Tesla, the same way they were looking at Tesla, in the mid-2010s.
Well, Pierre, as Sonali said, you're known as a Tesla bull, but you also cover a number of semiconductor names as well. So I want to bring you a Bloomberg scoop from this morning that China has restricted local companies from investing in the U.S. This is according to people familiar with the matter. The idea here is that this will give Beijing more leverage in trade negotiations. And that brings us to this afternoon, 4 p.m. We don't know what's going to happen necessarily just yet, but you think about these chip names that you cover, a lot of them are firmly in the crosshairs of these trade negotiations between China and the U.S.
Yeah, absolutely, Katie. So if you look at the situation today, let's take like a very simple example like NVIDIA. When NVIDIA is selling a chip $30,000 in the US, they're actually, the final assembly of that chip is in Taiwan, for instance, or we could take another example in China. And then they buy that chip for $6,000. So it's a very, very high gross margin business. So the impact of tariffs on that kind of business is only on the bill of material. And if you have like an 80% gross margin, it's a relatively small impact. You have to think about it like the worst case scenario, a 25% tariff would be 5 points of gross margin for NVIDIA from 80 to 75%, or like a 5% increase on the selling price of the chip. Now, why is China reacting with this idea of keeping their company from investing in the US? Well, simply because the idea of the administration is to force reshoring, to force investment in the US, to bring back blue-collar jobs in the US, to bring back manufacturing expertise and capability in the US. And so here we're seeing like a poker game where the US says, okay, we're going to add like a 25% tariff to force you to do things in the US. And then China is saying, well, we're going to tell our companies they can't do things in the US, which is like bringing up like the stake. Now the next stage could be if the US wants to go even further to say, well, fine, in that case, American companies with operations on the US soil are going to take the business away from the Chinese players. And then the negotiation is going to continue. And at some point, hopefully things will land in a place that works well and protects the interest of US companies. And with I would hope a reasonable balance between offshoring and keeping some of the activities, inshoring and keeping some of the activities offshore.
I think you make a good point, and that is that this move from Trump and the response from China could just escalate this thing into a trade war out of control. Pierre Ferragu, really appreciate your time from New Street Research. Thank you so much for joining us on Open Interest. Coming up, Big Pharma is bracing for uncharted territory as well as Trump's tariffs are set to take effect. This is Open Interest.
Well, the pharmaceutical industry is bracing for tariffs that may upend the drug world. In fact, nearly 90% of U.S. biotech companies rely on imported components for at least half of their FDA-approved products, according to industry estimates. Here to talk about the possible fallout is Sam Fazeli. He is senior pharmaceutical analyst over at Bloomberg Intelligence, joining us on set. It's great to see you in person, Sam. So we don't know a lot, but what we do know is that President Trump said on Friday that specific pharma tariffs were coming soon. Give us a sense of just how integrated the manufacturing supply chain for a lot of these big pharma countries are, because Ireland is popular for a reason.
It is, and the reason is tax, right? So if you manufacture your stuff there and then transport them over to the US at whatever transfer pricing these companies set for themselves, then you can avoid paying the US tax and pay much lower tax in Ireland. That's what's been going on for quite a long time now. And that's why the sector in Ireland is benefiting from that. The big thing for the 90% of companies that you suggested there is what type of product do they buy? If they're just buying product that's coming from China or from India or from Ireland or from, Switzerland, if it's just as simple as that, it's not intercompany transfers, then it tends to be the lower cost active ingredient type things where they then finish the product in the US. So the impact of that on earnings and cost of goods should be lower because they're usually cheaper. It's the branded product that takes the price, right?
So, first of all, you have a PhD also in pharmacology. You're not just like a Wall Street analyst guy. You also are read in. What kind of damage will these tariffs do combined with halting grants to universities, research universities in the U.S., which are the best in the world, right? We should, I think, be proud of them. What kind of damage will that do to pharmaceutical drug research, to healthcare in America?
Yeah, Matt, I have to say, you could take it beyond that. What kind of damage are these things doing to STEM in general? Now, mathematics perhaps is, but technology, right? A lot of DOGE cuts are going to be impacting the acquisition of technology from technology companies, right? And if you're also cutting the investment in the science side, whether it's drug research or tech research or whatever it is, then you're potentially putting the leadership of the United States in STEM at risk. And that is something that I'd like to take a deeper look at and see how far that can go. The other question is, where would this science move to, right? Because it's like you're squeezing here. Who else can invest at this level across the globe? You tell me.
Sam, I wish we had more time because for everything from branded drugs to generics, that's a whole other issue to be discussing, as well as the supply chain from academia. A lot to discuss and a lot of change. Sam Fazeli of Bloomberg Intelligence. Now, retailers, they're also bracing for Trump's tariffs. Walmart, in particular, is continuing to push Chinese suppliers to cut prices in order to offset the tariffs, despite getting pushback from Beijing. A recent drop in corporate and consumer confidence is forcing brands to cut their earnings outlooks. Let's discuss this with Telsey senior research analyst Joe Feldman. Every industry is really feeling various degrees of pain. When it comes to retailers in particular, where is the brunt of it?
Yeah, the brunt of it is really in things that deal with hard goods, metals, and really heavy exposure to China. So you see it in things like electronics and sporting goods, like hard goods, sporting goods like bicycles, toys, appliances. Some of those categories are most exposed to China and some of the other tariffs. Now, as this broadens out, we'll see what happens today at 4 o'clock, but it could have a big impact on quite a few companies in the retail space. Some are better positioned. We think like a Walmart has a broader, assortment of goods. They have, 60%, 65% of what they sell is groceries. So that's mostly a domestic supply chain, so you don't have to worry too much there. But then there's others like Best Buy, unfortunately, over 80% of what they sell is China and Mexico. Produced in China and Mexico. So, you have that issue. You have the dollar stores have a lot of product coming out of these countries. So there's pressure in certain parts of the market.
Well, to that point, Joe, Bloomberg News exclusive this morning that Walmart is continuing to push Chinese suppliers to cut prices to offset the impact of tariffs, again, according to people familiar with the matter. So we'll continue to keep an eye on that. But you think about the impact of tariffs, and there's actually two different sources of pressure here. You have, of course, input costs, what you were saying in terms of manufacturing and how these companies are exposed to China. But there's also the impact on the U.S. consumer, who might be tightening up their purses, their wallets, for example, and might not want to spend as much. So it really feels like it's coming from all angles here.
Yeah, that's a great point, Katie, that, you're really going to see it on the consumer side, because every retailer we've spoken to, every consumer brand has some amount of their pricing is going to go up. They're trying to work with the suppliers and share some of the burden there. The retailers and brands will eat some of the cost themselves, but a good chunk of it, maybe a third, maybe more, will get passed on to the U.S. consumer. And so it really will raise prices. Now, what we've seen historically, areas like food, for example, even when prices do go up, people obviously continue to eat. And so you're going to see that spending pullback on discretionary goods. And that's just going to further make more pressure on that side of the aisle within the retail space.
Hey, Joe, I wonder about Home Depot and Lowe's, not only because I would expect lumber costs and steel costs to be rising significantly, but of course, with mass deportations, you're going to have a dearth of construction workers. How is that affecting those companies?
Yeah, we're hearing a lot of pressure from those elements, especially on the deportation side. We've seen that in some of the service industries where you've seen a lack of available labor. Really, whether it's restaurants, hospitality, and retail, those are some big ones. And, beyond just, retail on the customer facing side, it's the back end of it too, right? It's the supply chain. It's in the warehouses. You see that pressure. You see, as you just mentioned, anything with steel and aluminum, think those items are going up in price. It's just going to be more pressure for the consumer. Lumber and building material costs go up in price. We've seen lumber prices already start to really jump through the roof. And that just puts pressure on the whole, ecosystem. Everywhere you look, whether it's building stores, building homes for new, when we don't have enough homes in the country, we're not keeping pace with the population growth. So you need more production and industry on the retail and consumer side. And this is going to be a dampening effect for sure.
Joe, great to get some time with you. Thanks so much for joining us. Telsey senior research analyst Joe Feldman talking to us about the effect these tariffs may have and other Trump policies on retailers. Looking at futures, we are sitting at session lows with S&P futures down more than 1%, just 4 minutes to go until the start of trading. We're going to start the day with Nimrit Kang of Northstar Asset Management and ask her what she thinks about the stability we'll get from this Trump announcement at 4 o'clock. This is Bloomberg. We are moments away from the start of trading. This is Bloomberg Open Interest, and it's Liberation Day. That's what Trump calls it, at least. He's going to tell us the tariffs he'll put on our major trading partners at 4 o'clock after the bell rings. Right now, we're seeing stocks, futures, I should say, at session lows. S&P 500 down 1.1%, NASDAQ down 1.4%, as is the Russell 2000. So the pain is spread across stocks. You see Smart Stop Self-Storage. They're not grumpy, right? They just raised over $800 million in an IPO. It's a REIT. Down on the NASDAQ market site, you have the Make-A-Wish Foundation, and I guess you can ask President Trump at 4 o'clock for what you want. In terms of the actual movement here, in terms of the stocks that are making moves, there are so many to choose from. Katie Greifeld, which ones have you chosen?
Well, I'm obviously looking at Tesla right now. We have that breaking news at the top of the 9 a.m. hour that global vehicle deliveries fell 13% in the first quarter, dragged down by the changeover of its most important model. We're talking about the Model Y there. Also, international backlash against Elon Musk. You can see that being expressed in shares right now, down another 6%. They were down 34% or so into yesterday's close for 2025, Sonali.
Katie, we're looking at dog days for the Magnificent Seven. If you look at the NVIDIA decline today, now another 2.6%. Shares are now down more than 20% on the year. All around uncertainty around the tariff impact on AI growth, worries about AI bubble-like behavior, a lot going on here, but we will digest the tariff impact more, Matt.
Yeah, that's a big heavy weight, so it's going to drag hard on the S&P 500 and the NASDAQ. In the health care sector, Hims is down sharply this morning. It plans to sell weight loss drugs like Zepbound from Eli Lilly on its new telehealth platform. But I guess this is not the day to make that kind of announcement, as we expect tariffs on pharma companies and pharmaceuticals as well. Joining us now to talk about all this is Northstar Chief Investment Officer Nimrit Kang. Nimrit, I guess President Trump is branding this Make America Wealthy Again, his tariff event. How do you expect it to affect the economy and the market?
We see it going two different ways later on today. You know, the first one is, of course, we see more of what we've seen before, just drip drab, big numbers, but really a lot of back and forth on implementation. That's one scenario that we expect. The other scenario, of course, Matt, is that it is a clearing event. We actually see a big bang number put out there. Maybe it's 20%. The market has a clearing event. Analysts can start pricing in what this mean for corporate earnings. We can start looking at, you know, what that means for the portfolio positioning and so forth, and we can move on from there. We think it's going to be more of the former than the latter, and we're going to continue to see this drip drab of news continuing to paralyze corporate activity, continuing to weigh on the consumer sentiment, and we expect that to go on at least for the next several months here.
Well, Nimrit, it's interesting to hear that you expect 4 p.m. today to be a clearing event, because there's plenty of folks on the street who are taking the other side of that. And actually, you had Barclays, the global head of Equities tactical strategies, saying that his main concern today is that Trump's announcement will leave room for interpretation. Trade policy will continue to be in flux. I know it's not your base case, but if that's the situation, that we end up with more questions than answers, what do you think that will do to sentiment?
You know, Katie, we think that continues to weigh on the sentiment. What that means is a lot of choppiness for the equity markets, right? The equity markets, S&P is down about 8% before today, as of end of yesterday, right? And if you go back to the Trump 1.0, the equity market S&P 500 was actually down 20%, and it took over 3 months for that to happen. This time, it's a lot more broad-based, both in scope and magnitude. And this time, there's a lot more what we expect an aggressive retaliation response from our trading partners. So we would expect this to continue on for at least several months, and continue to weigh on sentiment, both the consumer and the corporate sentiment.
Speaking of sentiment, I just want to pull up how sectors are performing today, Nimrit, because you don't see investors just pressing the hold button, you see people selling. And almost every sector to start the morning is in the red on the day, minus consumer staples, which is barely in the green. Of course, that is quite a defensive trade. Why do you think all the sour sentiment is still out there when the news we have so far about the direction of tariffs is still so sparse?
Sonali, one of the big things is, the market moves well ahead of estimates. We started the year off with the S&P growth for about 13%. We're now at 9.5%. But basically, the broad-based nature of the tariffs that we're expecting, it's going to hit every sector, really, other than maybe some of the very domestically focused companies. So that's what's affecting the sentiment. That's what the market is trying to get ahead of here, because, with S&P 500, almost 40% of the revenues coming from international and 40% of our cost of goods coming from outside of the US, it is a material exposure. And this time, to layer on just the tariff impact is the retaliation impact. I mean, you were covering Tesla just before that. You only have to look at Tesla and the year-to-date performance to know what happens when, the consumer sours on the brand. And so, do global consumers of U.S. products sour on the U.S. brand? That's what's weighing on. And that's why we see this just, get me out of the market, get me out of all these stocks. And of course, investors are sitting on a lot of gains that we have realized over the last 2 years.
I just want to point out that New York Mayor Eric Adams has had his criminal case permanently dismissed. So it looks like his trip to Mar-a-Lago paid off. He got his wish from President Trump. Can you look at, the winners in this market, Nimrit, or can you narrow down a group of companies that won't be affected by big tariffs and, put your money on them? For example, U.S. steelmakers seem to be quite happy about this whole situation.
You can definitely do that, but we think those are more trades, tactical trades, short-term trades. We would say that now might be the time to take that longer-term perspective. We're seeing a lot of dislocation in the equity markets. There are a lot of valuations are getting a reset. So this might be the opportunity to have some of that long-term thinking. If I take a step back and I say over a 5-year viewpoint, where do we see actually underlying growth drivers? The U.S. civil engineers just put out a report, which they put out every 4 years, showing how, first of all, they gave the U.S. infrastructure a C grade. Secondly, there's so much need for investment in our water and public infrastructure back here in the U.S. And if remanufacturing, getting the reshoring back here, manufacturing in the U.S. is a real thing, we're going to need to invest in our infrastructure. So with that viewpoint, why not take this time to do the work, look at some of the companies that are going to benefit longer term from that infrastructure spending back here in the U.S. and take some starting positions there.
Nimrit, great to have you this morning, of course, ahead of that tariff announcement, highly anticipated. That is Northstar Chief Investment Officer Nimrit Kang. Now let's get a look at some other stocks on the move with our own Bloomberg's Nora Melinda.
Sonali, I've got a few names here for you in the red this morning. I'm taking a look at telehealth company Hims and Hers. We're seeing shares lower after a 5% climb yesterday. And this is after the company announced that it'll actually be selling Zepbound, which is Eli Lilly's drug for weight loss. And this is really marking a departure from the company's focus on cheaper and compound drugs. But we are seeing shares lower as analysts and investors really digest the fact that Eli Lilly has reiterated the fact that they are not associated with Hims and Hers in this decision making, but much to keep an eye on here. Also keeping an eye in the banking space. Looking at shares of Truist, they're down just a touch this morning, and that's after Raymond James cut the stock to market perform from outperform. They're doing this ahead of earnings. We know bank earnings are on the way really swiftly. They're saying that they expect reduced financial guidance and EPS revisions from the company, but this is really just this idea that bank stock valuations are showing that investors are really leaning more toward the bear case for banks becoming a reality. And last but not least, let's take a look at Newsmax. This company has really been a high-flying stock for the past 2 days since it IPO'd on Monday. But we are seeing shares of the company that's owned by former New York Post journalist Chris Ruddy lower this morning, falling double digits after rallying more than 2,000% over the past 2 days. So we really are seeing this meme stock moment starting to wrap up a little bit. We'll see where it looks moving forward.
Yeah, I don't know who had Newsmax becoming a meme stock on their bingo card, but I certainly didn't. Bloomberg's Nora Melinda, great roundup as always. Now coming up, Bernstein analyst Daniel Roeska warns that tariffs on auto parts could, quote, break the system. He joins us next on Open Interest. Welcome back to Open Interest. A quick check on stocks. You can see the S&P 500 pairing gains right now, down only 0.5%. We were down by more than 1% just a few minutes ago. Of course, volume is very low right now because all the action is at 4 p.m. We'll continue to beat that drum, but it's time now for our top calls. Some of the analyst action in focus this morning, and first up, United Air is getting downgraded over at Raymond James, with the analysts moving to the sidelines because of increasing macro uncertainty. Next up, Citigroup upgrading Charles Schwab to a buy. The firm is expecting shares to benefit from increasing market volatility. And finally, Deutsche Bank downgrading Paramount, saying that other competitors are better positioned to weather a cyclical downturn. Matt Miller.
Turning back to cars, Bernstein analyst Daniel Roeska says the auto industry is facing an existential threat as Trump's tariffs loom. Roeska writes, even if tariffs prove short-lived, the risk of long-lasting operational damage is real. Investors need to ask, is the system ready for this? Daniel Roeska joins us now at the desk, and it's a real pleasure to have you here. Thanks so much for your time.
Thanks, Matt.
Do you think that investors have priced in the full cost and chaos, to use Jim Farley's words, that these tariffs are going to cause?
No, they've not. What the market's priced in is a 6 to 9 week vehicle tariff, but definitely no parts tariffs, and definitely also not that these vehicle tariffs will last longer than a quarter.
I think another important part of this is, fine, you might have the auto tariffs up front, but there's another layer here where the parts could also face significant tariffs. How would that add to the calculus here?
Yeah. So the auto tariffs, 25% on all imported vehicles, is about $70 billion of cost headwind for the sector. If you add the parts, you add another 30 to 40 billion. But the bigger problem is actually that there are very small suppliers, and suppliers typically only get their money after 60 to 90 days from their customers, the bigger suppliers, but they have to pay the border control after 10 days. And so there's a real working capital headwind that will happen at the border if these parts tariffs go into effect.
So that would obviously be ugly for the auto companies. Let's talk a little bit about the impact on consumers, because it's interesting. We've had a lot of delivery numbers come out in the past 24 hours or so. You saw GM and Hyundai sales jump because consumers are trying to get ahead of these tariffs and basically buy their cars now. I mean, putting together what you're saying, it sounds like maybe that's the move here.
Absolutely. Look, consumers are pulling forward. But that also means even without tariffs, we're going to see lower sales for the rest of the year. That also has an impact on the stocks because investors won't care in this uncertainty that they've already sold the cars. They only think about what's going to happen tomorrow. And then if you add the tariffs on, you would need to raise prices by 12 to 15% to offset the entire impact. That is not going to happen. The consumer will not be able to sustain that.
I saw recently that subprime defaults, or at least delayed payments, have risen to now pre-COVID levels, or at least early 2020. What kind of price effect do you expect this to happen? Because people are already looking at like $600, $700 payments. I think 15% of payments are over $1,000 monthly payments.
Yeah. I mean, you are going. If they raise prices, you are going to see significant declines.
Is it an if, Daniel? I mean, is some automakers, GM, going to say, we'll just take this hit to our bottom line. We don't need to pass it on to consumers.
Them to.
Yeah.
Well, he's been giving mixed messages on that. But I think the problem is that in each individual vehicle segment, there is somebody who sees quite a low tariff impact. So if you take large SUVs, GM is actually well positioned. While we think GM has a huge tariff bill on many cars, not in large SUVs. And that means they don't need to raise prices that much. Nissan will see a 20% impact of additional cost on their large SUVs. And so I think the price will be determined by the company that sees the lowest impact, and that's probably somewhere between 4 and 5% across the sector.
I'm going to test out a new Armada. this week, actually. And I guess it's going to be too expensive for me.
Yeah, after Liberation Day, you're still going to be driving cars. But let's talk a little bit about who will be least impacted. I'd take a look at your coverage universe. You cover Ford, GM, Stellantis, Rivian, Polestar. The list goes on. I mean, who is best positioned in your wheelhouse?
So since we don't cover Tesla right now, but Tesla is the name, right? So Tesla is least impacted by this because they make all of the cars they sell in the U.S. domestically. And the U.S. content in those cars is very high. It's about 60% of the value in a Tesla originates in America. And so they're actually the least impacted company.
It's funny to hear you say that. You wouldn't know that by looking at the shares that Tesla is best positioned here.
Yeah, but how have they done that, Daniel? I mean, how do they get so much of their stuff from America? And why can't Ford and GM do that too?
Well, one, they've, of course, started with the factories here. They then built the battery plants to support those cars, and that's a big part of the supply chain. They still get wiring harnesses and seats from other places, but it's just that a lot of the high-value components are made in the U.S. And for Ford and GM, they've used labor arbitrage to move the very heavy, intensive labor components to Mexico, where you've got a labor cost of about $5 an hour compared to, well, the lowest in the U.S. is probably around 20, and a UAW wage starts you around 80.
Daniel, we got to leave it there. Of course, a lot to break down and a lot in flux still as we wait for that Rose Garden announcement and those thereafter. That is Bernstein's Daniel Roeska. Now coming up, we're talking about it, the Newsmax rally. It's hitting the skids after an incredible run, a more than 2,000% one that just yesterday brought it above the market value of Fox. We're going to take a look at the news outlet that has become the new favorite meme stock. Still hitting a little bit of a wall today. Next. This is Open Interest.
This is Bloomberg Open Interest. Let's get a check on stocks. On tariff day, we don't see the drops that we were seeing at the start of trading or in futures. Right now, only 1/3% off the S&P 500, 0.2% off the NASDAQ. So some volatility in this market, to say the least. In terms of the individual movers, NVIDIA right now down only 0.75%. It had been down more than 2%, and that's a huge relief. Apple only down 0.25%. Trump media and technology, we're going to talk about that with Bailey Lipschultz in just a moment, but off another 6% today, and Newsmax down 36%. Okay, it had been up more than 2,300, and it's still worth double-digit billions of dollars, but some huge volatility there. Katie?
Yeah, it has been a wild ride with this media outlet. At one point, it had a larger market cap than Fox Corp, which is, of course, the parent company of Fox News. And it's still up about 1,400% over the past 3 days. So I don't think too many people are crying in their beer yet. But let's bring in Bailey Lipschultz. Of course, he covers IPOs, everything else at Bloomberg News. And Bailey, we were talking about how there's speculation that there's retail behind this move. The speculation being, take a look at the share price. Can we say that with authority, though, that this is a retail name?
Yes and no. When we look at some of the chatter on things like StockTwits, it definitely was the #1 trending ticker yesterday and the day before. One thing that I keep a close eye on is buy orders on Fidelity's platform, which they do still publish. That was a top 5 name yesterday, with buying still outstripping those to sell. It's hard to kind of parse through the data like we did back with GameStop, where there was so much excitement on StockTwits, Wall Street Bets, and other forums to outright call them retail-driven meme stocks. But when you see a company up 2,000% and you see people calling it America's stock and the company talking about buying the IPO, there definitely is a flavor of retail there.
Right. The flavor is interesting because when we're normally talking about IPOs and environment, you're looking for profitability. This is not that, is it?
No, not at all. And I think that's been one of the interesting things when you look at this IPO backdrop. Obviously, we talked about CoreWeave pricing poorly on Friday. It's now up 44% from its IPO. We did see buying in a few other small, tiny IPOs the last few days with some of these big rallies. So the big question is, when you have an IPO, you only have a small amount of shares actually available for trading. So with a company like Newsmax, how much is actually being flipped over by either Wall Street or Main Street? And how can you make a sense of some of this volume when, again, you're seeing the float flipped over essentially every day right now.
It's so weird to see. I mean, why would DJT be down 6% on Liberation Day, on Make America Wealthy Again Day?
Well, they filed to open the door to sell more than 142 million shares total. So actually, as part of that filing is Donald Trump, who owns 114.75 million shares of the company, filing to start the process, if they so choose, to tap the $2.1 billion in value. So you're seeing selling pressure. You're seeing a lot of speculation over if Trump will end up selling. He did move his stake in the company to a trust overseen by Don Jr. at the end of last year. Again, starting the process, it does not imply that sales are taking place now or will take place in the immediate future. This filing does actually need to be declared effective by the SEC, and that can take a few days. But certainly when you see a company that has been so heavily tied to Donald Trump's wealth, paper and real, that's why it's under pressure.
Right, it leads to the question, and if everything the Trump family touches, is it gold or not gold? In this case, Donald Trump Jr. driving down the shares of DJT. We spoke to Eric Trump yesterday. Hut 8, American Mining, Bitcoin held a little bit of a bid. They lost some of that yesterday, Katie.
Yeah, we'll have to continue to watch that one. But at least for today, we know that DJT is down pretty mightily. Bailey Lipschultz, it's great to see you. Let's take a look at the traditional market right now. The S&P 500 down about 0.4%, pairing its losses, but again, I told you to watch volume, and this is why. Volume is 18, nearly 19% below its 20-day average. We do have some selling pressure right now, but we know that the big event is at 4 p.m. We're not quite sure what's going to be delivered. Our latest reporting suggests that the White House team doesn't know either, so it's hard to make a big bet in this market.
I mean, Donald Trump himself has said that he already knows what he's going to do.
I'm just going off of our Bloomberg News reporting, Matt Miller.
I'm just telling you what the president said out of his mouth, right? Okay. So we'll see what actually happens. The silly thing is that some people expect stability after this. Coming up in the next hour, former Undersecretary of Commerce for International Trade, Stefan Selig, joins us in the studio, plus a read on the supply chain with FreightWaves CEO Craig Fuller. This is Open Interest. We are 30 minutes into the trading day. Welcome to Bloomberg Open Interest. I'm Matt Miller.
And I'm Sonali Basak.
And I'm Katie Greifeld. We take a look at these markets right now. In wait and see right now before that 4 p.m. announcement, you can see a little bit of a down day right now. Not as bad as it was. We were down over 1% at the open. We've since paired that to about 0.4%. And now we have some economic data to chew on right now. Factory orders for February coming in at 0.6%. That is slightly above expectations, about 0.5%. Durable goods, the final reading for February coming in at 1%. The expectation had been for 0.9%, so a little bit above expectations on both of those reads. Let's make sense of it now with Bloomberg's Michael McKee. What do you make of these figures?
I think the number we have to look at, Katie, is capital goods ex aircraft and defense, because that's the proxy for business spending that goes into GDP. That's what everybody's worried about for the first quarter. This is February data, and the capital goods number comes in down 0.2%. That is a little bit better than the negative 0.3 that we had in the preliminary report. Shipments are up 0.8, though. That is worse than the 0.9 that had been initially reported. Basically, what we're looking for is how bad is the first quarter going to be. Yesterday, the Atlanta Fed's GDP Now number came in at negative 1.4% adjusted for gold. And so this isn't going to add a whole lot to that. Friday also, we're worrying about what's happening with jobs, and the ADP number came in today. Didn't move markets at all because I don't think anybody's putting a lot of weight on it. 155,000 new jobs, more than the private sector forecast for Friday, but it is got some weird underlying stuff. 21,000 manufacturing jobs. The forecast in the Bloomberg survey is 0. ISM manufacturing employment fell according to that survey. And they said we lost 41,000 jobs out west and gained 89,000 in the Northeast. It seems a little weird, even with the California fires. So the data aren't giving us a whole lot of clues today, but I don't think anybody's paying all that much attention. Everybody's eyes on 4 o'clock.
We do see, 1% durable goods orders is better than the survey, and not as bad as a stick in the eye, right? I mean, people are still putting in orders, they're still buying stuff.
Well, a lot of this, Matt, is probably pulled forward because people were trying to get ahead of tariffs. Also, the headline number for durable goods is always affected by Boeing and how many planes they sell. But ex-transportation up 0.7, same as in the initial report. So it looks like there was some buying, whether it is standard or trying to stock up is what we don't know.
Mike, we thank you so very much for looking under the hood. Of course, that is our own Bloomberg's Michael McKee. Now, there's the economic data, and then there's all that tariff talk. And joining us now for the impact, Stefan Selig. He's Bridge Park Advisors managing partner and former Undersecretary of Commerce for International Trade under former President Barack Obama. Now, he helped negotiate the transatlantic trade and investment partnership between the U.S. and the EU. So there's a lot to say about what to expect in terms of how the EU might handle what's to come. But first, what's the cleanest read for the outcome of today's Rose Garden speech from where you sit?
I guess the clearest read is going to be the outcome is going to be undecided. And it's going to continue to evolve. I think the business community is clearly looking for some clarity, predictability going forward. I think we'll get some direction coming out of the Rose Garden today, but frankly, one of the things we've seen from this president and this administration is the ability to evolve his thinking.
Is the business community going to remain supportive of this president if he doesn't deliver at some point some level of stability, some level of certainty?
I think, Matt, that's the key question, right? The outcome of all of these tariffs is going to take a while to play out. The market reaction is going to be the market reaction. Frankly, our political leaders, while impacted by the equity markets and even the fixed income markets, while that is important, really what their job is to create good paying jobs for the United States and reshore some of that manufacturing and bring back some of those jobs that have been lost. That is going to take time to play out. The question is, how much pain is the economy and the markets going to suffer in the interim, and whether or not there's going to be the political will for this president and this administration to, keep it up.
By the way, is it worth it? By the way, if we go through this, right, pain and volatility and suffering, but at the end of 4 years, we have brought back millions of American jobs, high-paying manufacturing jobs to these shores. Is it worth it?
I think it is, with one caveat, which is even if the tariffs are effective from an economic perspective and do the things that you've just suggested, they legitimately might do, what has been the ramifications and the knock-on effects of that? What are the relationships with our allies and friends, and how badly have they been damaged because of the way we've treated them, for example? And is the light worth the candle? And that, to me, is really the question that will even take more time to figure out than just whether or not the tariffs have been effective. I guess the other thing I would say, it's effective in doing what? Mm-hmm. Is it effective in addressing our bilateral trade deficits with various countries? Is it effective in curbing fentanyl coming in from our southern border? Is it effective in our immigration policy? Is it effective in having Europe pay for their own defense? There are so many things that the administration and the president have talked about that tariffs are a cudgel to help address, but they can't all be accomplished because, in fact, they're mutually exclusive in many respects.
Right. It's a good point. What is the end goal? At one point, the administration was calling this a drug war, but clearly it looks like, just looking at the market and some of the headlines we've been breaking, this is a trade war. But you brought up our allies, and that's where I want to go, because Jason Furman was on Bloomberg Surveillance earlier today, and he was talking about our relationship with our trading partners, that basically you think about the knock-on effects here, that his view, this is going to drive our trading partners closer and closer to China. Is that your view as well?
I don't know. You saw all the press about Japan and South Korea now speaking with China directly about how to address some of these things. I frankly think that's a bit of a far reach, given how connected we are economically and politically. That being said, I think for sure we are going to move to a world of trading blocks, and that is going to take time. And what those trading blocks look like is still yet to be determined.
Stefan, I want to go back to something you were saying earlier about jobs, because if the point is to bring manufacturing back on shore, but you also have this ballooning federal deficit, and you see the administration cutting back on all sorts of spending. You have Howard Lutnick really threatening companies to pull back CHIPS Act funding. Then do you believe those jobs will really materialize if the government can't spend to get us there?
Well, it's not just spending, right? It's also where might they go, because some of these exports are not coming in from a particular country, right? So it is not clear to me that those jobs are ever going to come back to the United States. If you look at what really has caused the elimination of those jobs, for sure, global trade is a part of that reason, but really it's technology. If you go to factory floors, they don't look like what they looked like in the 1950s. That's what technology has done, is obviously going to continue to do and evolve over time.
I also want to tap into some of your prior experience before the Obama administration. You were one of the most senior deal makers at Bank of America. You have, even after that, served on the boards of many companies. You have worked with companies like Carvana, for example. So what's the readout from corporate America after all is said and done? We have seen a near halting of M&A. Yes, you've seen some things come through, but even if things are more certain, do you think that you see that comeback in Wall Street deal-making activity that has been so talked about when you have seen clear intervention from the Trump administration and its antitrust officials?
You know, look, the antitrust environment, I think, will be more rational than what we saw in the last administration, for sure. But M&A comes down to a confidence and lack of volatility. Clearly, what you're seeing is lower business confidence, lower consumer confidence coming out of these announcements. And I think if, in fact, we are right that the 4 o'clock call today is not really going to end this discussion and this debate, you will continue to see a dampening of deal activity for the foreseeable future.
Well, less than 6 hours to go, if I believe our little countdown clock. Hopefully we can bring that back.
Pull it back up.
Yeah, come on. It's doing a great job. So 5 hours and 50 minutes until we get that address. I want to talk about the positives here. When you think about the Trump administration's approach to trade, I'm taking a look at your notes. You write that this has been a wake-up call of sorts to Europe. You think about Germany approving $1 trillion in defense spending. I think that blew Matt Miller's mind.
Never would have expected that from the CDU.
Exactly.
Right?
So you could make the case that there are some silver linings to the chaos.
For sure, and that's a very good example. You know, the administration has given Europe and, in fact, Germany, in the case that you've just suggested, political cover to do the things they should have been doing for a long time. And so that's an outcome, a positive outcome, and there are going to be many others. You know, Doge, for example, I think the only thing that I can think of that has bipartisan support at the 80-ish% level is that our government is inefficient and needs to be cut. Now the question is, are we doing it in a smart and strategic and thoughtful way? Do we really want the richest man in the world on the stage with a chainsaw as the way to go do that? And so that, to me, is really the question, which is, not are some of the policies well-informed, constructive, and the right thing for our nation, but are they being implemented in a thoughtful, strategic, and tactical way?
If only it was just the chainsaw, right? Instead of the salutes that he's been giving. Stefan, great to have you.
Thanks, Matt.
I actually have one more question.
Oh.
And it's for you, for Stefan, actually. You know, speaking of Doge, I mean, the other aspect of this is efficiency. It's the idea of tax cuts, right? You know, you were talking this morning. I can't believe we went an hour and a half nearly without you talking about it.
I'm trying not to talk about it, but it's killing me that, you know, Donald Trump promised those of us who live in this part of America that he would lift the SALT cap that he put on in 2017. And now it looks like they're not even considering that.
Yeah, you know, look, obviously I'm a New Yorker, so I would be all in favor of that too, Matt. But I think one of the things that is clear is that if you look at some of the quite aggressive statistics that are coming out of the White House about the amount of revenue that could be raised from these tariffs, that the administration is going to look to justify tax cuts based on some of these tariffs and trade policies.
Stefan, we thank you for joining us. The reason I asked this, too, is because the other silver lining
I appreciate it.
Do we see tax relief, especially for those blue states?
Well, the question is, what is tax relief, right? Because for me, and it's not about me, obviously, but no TCJA. Like, I'll take the 2 extra points in my income tax if I can get a state and local tax write-off.
Matt has done the math, but it comes back to sequencing. That, of course, the priority for the Trump administration has been trade. Trump has billed himself as tariff man. Those market-friendly policies, lower regulation, tax cuts, they're clearly not as high on the priority list. But speaking of tariffs, don't miss our White House tariff announcement special. That's live at 4 p.m. New York time. Now, coming up, hedge funds saw wildly different returns last quarter in the face of Trump's trade wars. We'll bring you the winners and the losers next in our Wall Street Beat. This is Bloomberg.
It's getting out of high interest. Look at what's making headlines around the world. A federal judge is permanently dismissing corruption charges against New York City Mayor Eric Adams. This hotly anticipated decision followed a political firestorm ignited after President Trump's Justice Department ordered prosecutors to drop the case against Adams. The decision will allow Adams to campaign for a second term without the threat of jail hanging over his head. And Macy's is clawing back over $600,000 in cash bonuses from executives after an accounting scandal led to inflated pay. The retailer says it overpaid executives by about $609,000 as of the end of 2024. Yesterday, Macy's announced its chief financial officer was being replaced by Thomas Edwards, the former CFO at Capri. And Izzy Englander's Millennium Management and Ken Griffin's Citadel lost money last quarter, even as other hedge funds gained. Last month was fraught for many traders as a number of hedge funds suffered losses in equities, index rebalancing, and commodities. Some teams that managed money for multi-strat firms were stopped out, meaning they were forced to liquidate or trim their positions, and 2 trading units focused on index rebalancing at Millennium lost about $900 million as of early March. Sonali?
And Matt, that brings us to today's Wall Street Beat. Joining us now is Bloomberg chief hedge fund correspondent Nishant Kumar. Now, I want to point out that these multi-strategy firms, they are the whales in this ocean of a market, and you have Balyasny, Millennium for the quarter down 2% or more. Citadel from Ken Griffin also on the decline for the year. What does this mean in terms of the ability for these massive funds to take on more risk?
So we can look at it in 2 ways. Yes, they lost money, but March was an amazing month where the risk management did kick in. So if you look at the first week of March, that was really brutal for some of these firms. The losses were much, much deeper. But they again proved that through the month, they made changes, the degrossing happened, and in the next 3 weeks of March, they recovered most of the losses that they had posted. So, you know, March is a losing month, but it's not a disaster for them.
Well, let's talk a little bit more about the folks who did well. I mean, you're right, Renaissance Technology, David Einhorn's Greenlight Capital, we could see that on the table. What is standing out for them that actually helped them kind of do well in March when others failed?
So the quant strategies have done well. So that's one consistent trend that we see, although we have very limited amount of data, so we should be careful about making judgments on that. But generally what we are seeing is fixed income did well, so some of the macro traders did well. Quant strategies did well, as well as some of the equity market neutral strategies performed really well. We just broke a story about a Citadel a spin out, like the former Citadel traders, Fifth Delta, they're making 9% in the first quarter. So we are seeing some really big positive returns as well. But in the multi-strat landscape, we are yet to see any significant winner coming out of March.
You are supposed to be protected from losses with hedge funds. At least that's the way I understood it when, you know, I first started looking at these things 25, 30 years ago. And we have seen a down market, right? At least here in the U.S., the S&P is down about 5% year to date. Are these funds beating that? Are they keeping investors from losing as much money as they would in the market?
So all these three multi-strat hedge funds that you mentioned, they have all outperformed, although they have lost, but they have outperformed S&P 500. We also need to take a step back and look at the broader context. Look at the last 5-10 years. You know, all these hedge funds have performed really well, consistently posted positive double-digit returns on a high Sharpe and low volatility. So that's what investors look for in a hedge fund. You know, beating S&P in a bull market, for that you go to ETF long-only funds, not to hedge funds.
To Matt's point here, we're finally hitting this market hiccup. You had 2 years of equity markets going straight up to the tune of double-digit percentage points. Now that we're hitting a rocky world, where are people going? I'm still struck by the immediate reaction you had from the co-CIO over at Citadel, asking his traders to play offense. Where's the offense?
So that really helped them. So if you look at Citadel example, in the first week, we reported they were down 1.7%. They ended the month down like 0.5%. So that offense kind of helped them to recover from their losses. And going forward, I mean, volatility is a friend of hedge funds. It may not be a friend in the immediate, like few days or few weeks, but over time, this kind of a market is going to help hedge funds make more money and really show their worth.
All right, Nishant, great reporting as always. Really appreciate you keeping the scorecards of all these different hedge funds. That is Nishant Kumar. Now, still ahead, Hims & Hers is expanding its weight loss offerings, including access to Zepbound, but it's going to cost you. Details next on Bloomberg Open Interest. All right, it's time now for Social Climbers. The company's making waves this morning. And first up, Hims & Hers Health is broadening its weight loss offerings, adding access to brand name shots such as Zepbound. Remember, the company previously focused on cheaper compounded versions, and a monthly prescription for Zepbound will cost about $1,900 a month, which is $800 more than what Eli Lilly itself charges. Next up, we have Walmart still pushing its Chinese suppliers to cut prices in order to offset Trump's tariffs. Walmart is requesting that suppliers cut prices by as much as 10% for each round of tariffs. And finally, we have Truist getting downgraded over at Raymond James, the firm highlighting the stock's unattractive valuation and mounting headwinds ahead of earnings coming up in just a couple of weeks. Stock is pretty much unchanged at this moment. But let's take a look at what's going on in the broader market right now with less than 6 hours to go until that 4 p.m. Rose Garden announcement on tariffs. You can see the S&P 500, the NASDAQ 100, they've been pairing gains all morning. That was accelerated a little bit after we got that eco dump at the top of the 10 a.m. hour. Of course, factory goods and durable goods coming in better than expected. You add that to what we got from ADP at 8:30 this morning. More jobs than expected were added in the private sector in the latest reading. But again, it's all about what happens this afternoon. And coming up, as I've been saying, brace for impact. President Trump is set to unveil his package of tariffs later today. We'll break it down with FreightWaves CEO Craig Fuller joining us next to show us what he's already seeing. This is Open Interest.
The impact is freight rates will go up, no matter what. And unfortunately, there's no choice but to pass that along to the cargo owner and ultimately the consumer. Is it an apocalypse? I don't tend to be that dramatic.
That was the Genco CEO John Wobensmith saying tariffs and other protectionist measures taken by the Trump administration will push freight rates higher. FreightWaves tracks pricing for the global freight market, keeping an eye on logistics and supply chain in real time. We're joined by their CEO, Craig Fuller, now. So, Craig, it was fascinating to talk to Wobensmith yesterday, and his point was what they're going to do is either avoid the U.S., since they do 90% of their business elsewhere, or just pass the costs along to shippers who will pass it along to consumers. Is that what you're hearing from everyone else as well?
Yeah, it depends on where you sit in the supply chain or in the freight market. So every one of the different participants, whether we're talking trucking, rail, air, and ocean, has experienced its own version of the market. Ocean container volumes are at record highs, actually beating out the COVID highs, and they have experienced incredible volumes. Trucking is actually quite sluggish. We had a nice recovery from the Great Freight Recession, which has been going on since 2022. It was recovering well after the election and up until inauguration. And really, Valentine's Day on, we've seen a pretty sharp slowdown in trucking demand that has been really caught the industry off guard.
I want to talk about the pull forward effect. We were talking about it when it comes to the automakers. I mean, you have consumers buying cars ahead of these tariffs being placed on. Are we seeing that on the part of other industries? I mean, if you take a look at the retailers, for example, are we seeing any stockpiling going on there?
Yeah, absolutely. We've been seeing it since last summer, since it became apparent that Biden was not going to win the election or become the candidate, and it looked as if Donald Trump was more likely than not to win. The supply chain industry, retailers have been importing, manufacturers have been importing, understanding that trade policy was going to change. Donald Trump made it very clear that he was intending to use tariffs as a part of his strategy. And so most importers of any scale have been planning for this and have been pulling forward. And that's what has been driving the international container movements. And what has benefited is the international ocean container companies have actually benefited greatly from this, but so have the railroads, because intermodal, which is a slower form of domestic transportation, have also benefited because effectively these have been warehouses on wheels. They're moving warehouses that the retailers have been taking advantage of the very slow transit times because they haven't needed inventory and have been able to use that inventory for just pre-stocking purposes.
What can you deduce from that pull forward, though? Because what you're seeing, for example, from the automakers, fine. People are buying things now. People are stocking inventories now. They have been for months. But what about when you start to see these tariffs start to take fuller effect and even more of them?
Well, could see a drop off. I think the question that most people in supply chain are asking is, when is enough or when does this end? Like, what is the end game for this? And I think as long as there's uncertainty, I believe that companies will continue to import at record volumes just to protect their supply chains. Once it looks like we have some reprieve in that, and once we understand what this is actually going to look like, I think we'll see potentially a small hangover because they have so much inventory and they won't feel like they need to prepare. So that's what we're looking for. We're looking for direction. We're looking for specifics. I think the thing that's really caught most people off guard is the focus on Mexico and Canada. I think largely the industry expected tariffs and tariff pressure on places like China and Vietnam and perhaps India. Didn't really see the level of attention and focus on Canada and Mexico. And I think that's caused an enormous amount of anxiety and frankly is probably sapping a lot of business confidence because people don't know how to plan around that. If we're going to rebuild manufacturing in the United States, we have to have the components and the commodities from Canada and Mexico to build that. And I think that's what's caused an enormous amount of anxiety, is that in many ways was unexpected.
Yeah, I mean, they probably thought USMCA was a good deal, maybe the best deal ever. Turns out it was awful and not worth the paper it was written on.
Donald Trump said as much. I mean, he said this was the best trade deal he's done. So,
he also tried to block TikTok, right, with an executive order. And now he's trying to save TikTok and he's willing to trade tariffs for it. Let me ask about Chinese-built ships, because this is a huge story. And we were talking again with Wobensmith yesterday, and he said, look, there aren't U.S.-built ships. We don't have the big shipyards anymore. and they're not coming back. Do you think that's the case?
Yeah, I think, the reality is that, well, first of all, there's the policy element of these fees that the United States wants to put on Chinese chips. And to be very clear, this was something actually that the Biden administration teased before in the previous administration. So it's something that's actually likely to stay in place. I think the frustration is that we don't build chips in the United States, and there's a lot of policy changes that need to take place. There's also a lot of government funding and support that needs to happen in order to affect that, to change that, which seems very unlikely. It doesn't seem like we want to spend the money to actually build domestic shipbuilding, which is really the biggest issue here. But I do expect these fees to stay in place, and as they do, they will create pressure on international shipping. It doesn't look like the Trump administration plans to reverse those. It also doesn't look as if the Democrats will have the resolve to reverse them if this does come into effect.
Craig, we thank you so much for your time, for breaking down all the tariff effects. That is Craig Fuller, FreightWaves CEO. Let's get a check on these markets, because you're looking at an S&P 500 trying to erase declines. It was up for a moment, now back down about a tune of 0.1%. The NASDAQ 100 still losing a little more than 0.1%. It's interesting, if you look at the components of the S&P 500, guys, it's really that financial sector that is leading the sector-wide rebound. You're not seeing the other sectors face the same kind of rebound. Yields are nice and low. We're watching that 10-year hang out below 4.2% most of this week, all week really, trying to flirt to get to as low as 4.1%. Discover, MasterCard, Capital One, even the big investment banks are really up on the day, but there are a few other things as well.
Yeah, I mean, if you take a look at what's moving in the S&P 500, it's pretty much an even split if you just take a look at the top 500. We have to talk a little bit, though, about Newsmax and CoreWeave going in different directions. Newsmax to the downside, CoreWeave, it has a pretty rocky debut, but now it's moving to the upside. So trading places there a little bit.
Yeah, I mean, so Newsmax is not a surprise, right? This was a $265 stock yesterday. It's $124. I'm sure if you go on Wall Street Bets, you'll see everybody looking for tendies here.
It's a hot topic.
It's a rug pull. But CoreWeave is, to me, that's very surprising. I mean, this was an IPO that went off really poorly. I think they sold shares at $40 a pop, right? And now it's trading up to 60. What drove it up 40% yesterday? I have no idea.
Cathie Wood was buying.
That's true. Cathie Wood did buy in some of her funds, but I think it was just punished. You know, it IPO'd on a really difficult day for a technology company, and now you're seeing a little bit of the bounce back here.
There is some comfort to be taken in that correction. The things that went up have gone down.
The pause that refreshes, as Adam Johnson used to say. Yeah. Well, I guess Cathie Wood has some power to move these markets because she's boosted CoreWeave by.
I don't know. They're not the only ones. They're not the only ones. Anyways, let's get a look at some of the other stocks moving under the hood this hour. We're going to bring in Bloomberg's Nora Melinda for that.
Well, I've got one of the big names on my mind this morning, keeping eyes on Tesla. We are seeing this as the biggest drag on the Mag 7 stocks this morning. And of course, there's a lot of things in the news flow as it pertains to Elon Musk and Tesla. But today we're seeing traders that are looking at vehicle sales that fell 13% last quarter. That's an almost 3-year low for the company. And then on the other end, we had first quarter deliveries that came in worse than expected. Even Wedbush analyst Dan Ives, who tends to be a bull, he said that this is, quote, a disaster for the bulls. So lots to keep an eye on here as we look at Tesla. But another vehicle maker that I'm looking at is Rivian this morning. Down as well.
Even though it delivered thousands,
I was going to say
multiple thousands of vehicles
in the quarter. Wow.
Yeah. Yes, and Matt, I know you're the car guy, so I'm sure you're all caught up on this stuff. But we're seeing first quarter deliveries that came in line for Rivian, but as you mentioned, still kind of getting beaten up a little bit. Vehicles were delivered about 8,640 against estimates of 8,610. So the scrutiny there is interesting for me.
Yeah,
I see a lot of them on the road.
I see a lot of them on the road. They're very cool vehicles.
I mean, how many people bought the gas guzzlers, though?
Yeah,
Fair.
no, but they're just as expensive, right? I was just looking at a Chevy Suburban. If I go with the 6.2 liter V8, which is really your only choice,
right?
It starts at 87 grand, right?
Too
That's
much.
even more expensive than a Rivian with like the tri-motor. So
In this economy,
Yeah.
that is a tough price tag to swallow. But what's going on with Verizon, Nora?
Verizon, I mean, we're seeing shares down just a touch, but they've really been involved in this years-long battle with investors. Investors were suing Verizon, AT&T, Lumen. This is all over allegedly toxic and often buried lead cables that were inherited from former Bell System regional telephone networks. So they've really been in this legal battle here. But we are seeing that investors essentially, Verizon's getting off here, it seems to be the case. But they are saying that they felt that the company knew for a long time about these cables. But it seems that Verizon is turning out all right in terms of this battle that it's been dealing with right now.
Nora, thanks so much for joining us. Nora Melinda there on some of the stocks that are moving in this market. I want to bring you some breaking news on Europe right now. The EU is preparing a package of potential emergency measures to support parts of its economy as Trump moves to raise tariffs. The European Commission, the EU's executive arm, working on short-term economic support proposals to go alongside plans to advance reforms and competitiveness in key sectors. This is just going to exacerbate the trade war. Everything we hear, right, from China, how they're going to stop their companies investing in the U.S. and the EU working on all of these sort of non-tariff protectionist measures.
Yeah.
It's just going to ratchet it up.
Well, we heard from the press secretary that Donald Trump is, these are going to affect the tariffs at 4 p.m. apparently, but he's willing to negotiate, always willing to take a phone call. But taking a look at some of these headlines that we're getting, this one from the EU planning its emergency measures. To your point, Matt, I don't know if it's going to, I don't know if they're getting on the phone.
I mean, the amount of money that Europe is going to have to spend just to kind of stave off some of this pain, in addition to that defense spending, that EU versus U.S. trade.
Maybe they should be, maybe it's time for Eurobonds. Maybe they need to do their own TARP. All right, coming up, TikTok's future in the U.S. President Trump is set to hold a meeting on a potential sale of TikTok today, and he told us that he would trade tariff points for Chinese approval on this. So TikTok means a hell of a lot to this president. More on that story next. This is Bloomberg.
Well, President Trump, in addition to that tariff get-together at 4 p.m., he will be meeting with top officials today to consider proposals for divesting TikTok's U.S. operations from its Chinese parent, ByteDance. The deadline for ByteDance to find a buyer is Saturday. So let's break it down now with Bloomberg Balance of Power co-host Kaylee Line. So a busy day, of course, for President Donald Trump. Let's talk specifically about TikTok to start. So what do we know about this proposal and these discussions? I mean, Oracle and Blackstone, these are names that have been floated.
Yeah, and of course, Oracle already has been involved in TikTok's U.S. operations, but this is what Bloomberg is reporting, citing people familiar with the matter, that this would be structured as kind of a joint venture with partners including Oracle and Blackstone, and Oracle would take a partial ownership stake in TikTok's U.S. arm and take control of data security while potentially leaving the algorithm in the hands of its Chinese parent. And this raises a couple questions. One being, will this be seen as adequately compliant with the law if this is the deal that they ultimately end up with, given the law was specifically designed to address concerns around data privacy and propaganda being used by the Chinese Communist Party on the platform? The second question, though, is if the algorithm is allowed to stay in Chinese hands, does it actually make it easier for China to agree to this deal, which is something that is likely going to be needed? And President Trump has suggested that multiple times in the last few days that if he is not seeing a willing China, he might be able to offer them some relief when it comes to tariffs in order to get them to agree. All of that said, of course, for all of this to come together, we are dealing with a very limited time window. As you said, Katie, the deadline is Saturday, though the president has also suggested he could just extend that deadline, as he's already done once, which is why the deadline is today, or Saturday, 75 days after the original date of January 19th.
Now, I also want to talk about what's happening in tax world right now, Kaylee, because, of course, in addition to the tariff talks, you do have President Trump, according to Bloomberg's reporting, meeting with Senator John Thune today as well to discuss these plans. The Republicans have put up that SALT proposal as well. Matt has a lot of comments about those. But how do you think it's going to go, given that the tax part of the story is so critical to the overall growth plan?
Yeah, it's going to be difficult for the Senate and House to fully reconcile their budget reconciliation or budget blueprints, which is what the Senate is trying to advance this week, trying to bring it more in line with what the House has outlined in terms of what the actual spending levels will allow to be from the current policy baseline and how many tax cuts could emanate from that, keeping in mind that just the extension of the 2017 tax cuts is one thing. Everything else, including potentially a lifting of a SALT cap, are things that would cost extra on top of that. On the SALT cap, Bloomberg did report yesterday that the plan Republicans are currently considering would see it lifted by $15,000 to $25,000 from the current $10,000. I actually spoke with the former chair of the House Ways and Means Committee, Kevin Brady, who was one of the key negotiators of the 2017 tax package. He was surprised. He thought that number actually was a little bit higher than he thought it would be. But we also spoke to a current member of the Ways and Means Committee, Congressman Greg Murphy of North Carolina, who suggested these are still negotiations that are fluctuating. They have not settled on any number yet. So it's possible that number could go higher or lower. It just depends on where they end up trying to find a happy medium between the SALT caucus, people that represent districts like Matt Miller's, and those who are a little bit more reluctant to offer that kind of break to blue states.
Let's not forget that the president said he would remove the SALT cap when he was campaigning here in New York. And the president put this SALT cap in place with the Tax Cuts and Jobs Act. For a lot of people around here, it would be much better off if the TCJA just didn't get renewed. What's the likelihood that they're going to push through those tax cuts?
Well, Republicans will tell you the biggest devastation of all would be if the TCJA is allowed to expire at the end of the year, that would be an equivalent of a massive tax hike on the vast majority of Americans, though depending on your specific financial situation and where you live, obviously the SALT cap influences that as well. I know well how you feel about this, Matt, but they are obviously trying to make sure that this gets done before year end. It's just going to be a question of whether or not they can fulfill all of the promises President Trump made on the campaign trail when it comes to taxes, not just on SALT, but no tax on tips and Social Security, all those things as well.
All right, Kaylee, you have a busy day ahead of you. Our thanks to Kaylee Lyons joining us from Washington. And don't miss our White House tariff announcement special. That's live at 4 p.m. New York time. This is Open Interest. Welcome back to Open Interest. We actually have a rally on our hands, just slightly, but you consider we started 1% lower at 9:30. Quite a turnaround in the S&P 500. The trading volume, about 23% below its 20-day average. What's dragging us to the upside, it's Apple up about 0.5%, but on a points basis, that is your biggest winner, Sonali. On the downside, you have Nvidia, Tesla, Alphabet, and GE weighing on this index still.
And joining us for a closer look at how markets are preparing for today's tariff announcements, we're going to bring in Bloomberg's chief correspondent for global macro markets, Liz McCormick, because, of course, the macro is really the one that is moving the most. Even if you look at the 10-year yield, you saw this massive jump on the expectation of inflation relative to the tariffs in the wake of the election. You saw so much of that wiped out. You've seen in the 10-year yield alone this week a nearly 7 basis point move lower. It feels, Liz, like that 10-year wants to hit 4.1%. When you look around, when you talk to traders, are they a little worried here about these overcorrections or corrections, if not overcorrections?
Yeah, Sonali, like you said, massive move, the reverse of what we saw after the election, because people are pricing in that these tariffs are going to be more of a hit to the economy now, the way it's been coming through, than inflationary. So I think, yeah, people are really worried today, of course, about what comes at 4 p.m. from the president, mostly because they want to know that this uncertainty is a big factor in the markets. Just what is happening. You can't price uncertainty. So number one, people are wary, like, will we come out of this announcement and still be uncertain? So they're hoping whatever it is, at least it's clear. People are looking at, like, what's the level of tariffs, but also, does it look like it's a negotiation tool, or is it just a lock? So there's just a lot looking at this. But yeah, bond yields have fallen a lot because it's all about the growth for them. But if the tariffs seem less stringent and more of a negotiation tool, meaning maybe they don't all stick, that may see yields come back a little because the economy would take less of a hit, people feel. But we just don't know. So we're all waiting on bated breath.
But I heard this from Barkin yesterday, that he thought maybe after this we'd move towards stability. Does anyone really believe that, Liz McCormick, that we're going to move in this administration towards stability? Does anyone really believe that these tariffs now are a negotiation tool because they haven't really floated any balloons or given any indication of where they're going, or, as far as I know, held serious talks with our trading partners?
Yeah, I don't think anyone believes, like, remember, Matt, when we came into the year, people thought, oh, it's going to be more about the tax cuts and tariffs. So it's kind of like Trump 1.0. And clearly, you're right, it's not. So no one thinks they're going to go away. But there is some hope that maybe there's some room for negotiation. Like, I think Treasury Secretary Bessent said that maybe the levels are like a cap. They're open to working with the partners, do as they wish they will, to not be as high as they could be. So I think there is some belief that maybe that it's a little bit negotiation, but clearly you're right. No, it's not that they're going to just go away and he's going to change his tune on tariffs. Tariffs are very important to his policy for sure.
All right, Liz McCormick, great roundup as always. That is Bloomberg's Liz McCormick. Your 10-year Treasury yield sitting at 4.16% heading into 4 p.m. The S&P 500, Matt Miller, cooking up a third day of gains.
Yeah, a little bit of a turnaround from what we saw pre-market, and it's not impossible that we see a turnaround again. Don't miss our White House tariff announcement special. That's the name of it, the White House tariff announcement special. Live at 4 p.m. New York time. It'll be better than the name. This is Bloomberg.